A very good evening to all the participants of this webinar. In this webinar, we welcome you on behalf of the DTRTI Lucknow. The topic of today's webinar is basic accounting procedures, and we are going to do journal entries part 3 as part of the basic accounting procedures today. Friends, we are going to discuss the traditional approach. We have already discussed the approach based upon the accounting equation, which is a more modern approach. And in today's webinar, we'll be discussing the traditional approach. Towards recording transactions in the journals. Now, under this traditional approach of recording transactions, we have to first understand the terms debit and credit. And to understand these terms, debit and credit, and their rules, what we would like to say is that the term debit and credit, we have already explained earlier that debit means left hand side and credit means right hand side. Now in the journal, the transactions are recorded on the basis of the rules of the debit and credit only. We have to apply those rules and record the transactions. So for the purpose of recording the transactions in the journal, through the journal entry, we divide the transactions, or we classify the transactions into 3 different groups. So let us understand these 3 groups of transactions. The first group is the personal transactions. The second group is the transactions which relate to the assets and to the properties. And third is the transactions. Third group is the transactions which relate to expenses, losses, incomes, gains, etc. So broadly speaking, the transactions are grouped according to whether they are capital in nature or whether they are in the nature of assets and properties, or the transactions relate to assets and properties, and whether the transactions relate to the expenses, losses, incomes, and gains. The expenses, losses, incomes, and gains, they form part of, normally they form part of the profit and loss and the trading account. The personal transactions normally relate to capital account, and the transactions which relate to assets and properties normally relate to the balance sheet. So we can say that these 3 groups are corresponding to capital account, balance sheet, and to the profit and loss and trading account. Now let us try and understand this classification in more of detail. First of all, let's understand what are the personal accounts. Personal accounts are those accounts which relate to persons and which relate to trade receivables or trade payables. For example, it's like account of a company, or let's say Ram and Company, which is, let us say, our customer. So when we say account of Ram and Company, it is a personal account of Ram and Company. Or when we say account of Javeri and Company, it is the personal account of Javeri and Company. Javeri and Company could be a supplier of goods to us. And therefore, it is a trade payable account, or there could be a trade receivable account of a customer who is buying from me. Capital account is the account of the proprietor, and therefore that is also a personal account. But it is also personal, but adjustment on account of profits and losses are also made in the capital account. Now this account or personal account is further classified into three categories. So there are three categories of personal accounts. So first of all, we have to understand the personal account relates to either a trade receivable or a trade payable, because we are buying from somebody and we have to repay that person, or we are selling to somebody and we are going to get money from that person. Person means personal account. So it could be a credit customer or it could be a trade supplier. Then among the personal accounts, there is capital account also, which is the personal account of the proprietor. However, in the capital account, we also make adjustments on accounts of profits and losses. When we say profits and losses, those transactions relate to expenses, losses, incomes, and gains. Now, this personal account is further classified into three categories. First is the natural personal account and relates to transactions of human beings like Ram, Rita, etc. They are the natural persons. Then there are some artificial persons or legal persons, because for business purpose, business entities have to be treated as separate from their owners, and therefore they are legal persons. So they are recognized as persons in the eye of law, not in the eyes of people. So those artificial persons are persons in the eye of law for dealing with other persons, whether they be natural or unnatural. For example, governments, companies, whether they are private companies or limited companies, the clubs, the cooperative societies, all these are artificial persons or artificial legal persons. And their accounts will be artificial or legal personal accounts. So a person can be natural, a person can be legal, or created by law, let's say, or recognized by law. Then there could be representative personal accounts, because these are not in the name of any person or in the name of any organization, but they are represented. They are represented as personal account. For example, at the name of the account, they may not be seeming as if they are accounts of any persons, but there could be a number of persons involved in that account. For example, an outstanding liability account, where liabilities of number of persons are grossed together, or a prepaid account, or a capital account, or a drawings account. All these accounts, may not be belonging to one person, but they are represented as if they are personal accounts, or they are shown as if they are personal accounts. So outstanding liability account, prepaid account, capital account, drawings account, they are all representative personal accounts. In other words, we can say that those accounts which are personal accounts but not natural persons or artificial persons account, but they are represented to be personal accounts, they are all called representative personal accounts. Now, the second category is the impersonal accounts. So among the impersonal accounts, accounts which are not personal in nature, they may be dealing with properties, as we have mentioned here, or assets. So the accounts which deal with properties or assets, like machinery account, cash account, rent account, these are all impersonal accounts which have got no relation with any person as such. Absolutely no relation with any person. Therefore, they can be subdivided also among real, nominal accounts. So impersonal accounts can be divided into two parts. One is real accounts, other is nominal accounts. Real accounts means accounts which relate to assets, but they don't relate to debt. This must be remembered that debt is being covered not under the impersonal accounts, but rather debt is being taken to be covered under the trade receivables, or rather the trade payables, and therefore the debts are covered under the personal accounts. As far as the assets of the firm are concerned, the trade receivables are also personal accounts. So real accounts are those accounts which relate to assets of the firm, which are the concrete assets of the firm, not the trade receivables or something like that. For example, accounts about land, about building, about investment, about fixed deposits, they are impersonal in nature and real impersonal accounts. So similarly, cash in hand or cash at bank are also real accounts because they deal with real assets. Nominal accounts are those accounts which relate to expenses, losses, gains, revenue, etc. Like salary account, interest paid account. Normally these accounts will be finding a mention in the profit and loss account, commission received account. Nominal accounts are those accounts which are accounts only in name. They are not real accounts. As number of accounts are grouped together as part of the profit and loss account, and they are all grouped together over there. So they are just named to be accounts, and they are not actually real accounts. Real accounts are those accounts which belong to some assets of the firm. Nominal accounts do not belong to the assets of the firm. Secondly, nominal accounts are accounts in name only. Thirdly, nominal accounts are accounts relating to expenses, losses, gains, or revenue, etc. Like salary account, like interest paid account, or like commission received account. You'll ordinarily find mention of these accounts in the profit and loss account. The net result of all the nominal accounts is going to be reflected in the profit and loss account. And finally, this profit or the loss, which is appearing in the consolidated way in the profit and loss account, will be transferred to the capital account. So we can say that the nominal accounts are ultimately only temporary in nature, and the balances of the nominal accounts, or the single profit balance, consolidated profit coming out of these temporary accounts, is ultimately credited to the capital account. Therefore, nominal accounts are temporary in nature. So accounts are basically of two types, personal and impersonal. The personal accounts may relate to debts and to natural persons or legal persons, or a group of persons included under, let's say, outstanding liability or prepaid account or capital account even. Capital account, if we were to think about capital account, it is a personal account of the proprietor. Similarly, drawings account is also the personal account of the proprietor. So personal accounts could belong to the proprietor, could belong to the supplier of goods, could belong to the customer. And there could be natural or legal personal accounts also. And the second type of account is the impersonal account. And under impersonal account, there are two types of accounts. One are the real impersonal accounts dealing with assets of the firm, And the other are the nominal personal account, nominal impersonal account, which are accounts only in the name. They are just made there temporarily, and then they vanish, and finally they become part of the capital account. The balance becomes part of the capital account because profit and loss, whatever is generated, will move into the capital account ultimately. So when you have to draw a distinction between personal and impersonal account, we have to be very, very clear. The first distinction we have to draw is personal or impersonal. Among impersonal, we have to draw the distinction between real and nominal. And among personal accounts, the distinction has to be drawn between natural person, legal person or artificial person, and group of persons, which are representative personal accounts. So having understood this broad classification, sometimes this broad classification leads to confusion also, but having understood it in a little bit of detail, we would like to go into the golden rules of accounting, like how the debit is done and how the credit is done. So all the classified accounts have two rules, and whereby it is meant that every classified account, or the way the classification is made above, each of the classified account has two rules. One rule relates to the debit and the other rule relates to the credit for recording the transactions, which are termed as the golden rules. So these two rules are called the golden rules of accounting, as transactions are recorded on the basis of the double entry system. So the rule is that if there is a personal account, so as you have seen, the account could be either a personal account or it could be an impersonal account. If it is impersonal, it could be real or nominal. So if it is a personal account, we debit the receiver and we credit the giver. If it is a real account, we debit what comes in and credit what goes out. And if it is nominal account, we debit the expenses and losses and we credit the incomes and gains. These are the golden rules of accounting. The first step is to decide what type of account it is. The second step is to decide who will be debited and who will be credited based on these golden rules. Now let us take an example. We have some information in 5 lines and we say that the question is to state what is the nature of that account. Nature of account means classification of the account, and state which account will be debited and which will be credited. So how do we find out which account will be debited and which account will be credited? We have to use these golden rules of accounting. Before we use the golden rules of accounting, we have to decide that what is the nature of the account in which debit or credit will happen. Now let's say, for example, that somebody started a business with a capital of 50 lakh. So when we say that somebody started a business with a capital of 50 lakh, that means that it is a capital account which is being affected here and a bank account which is being affected. So two accounts are being affected. One is the bank account and other is the capital account. So as far as the bank account is concerned, the bank account is the bank account of the proprietor and therefore it is a personal account. Capital account is the capital account of the proprietor, therefore that also is a personal account, and therefore the rule for the personal account is debit the receiver and credit the giver. So therefore here money is being received by the bank account. So the receiver is the bank account and giver is the capital account. So that means that the giver here is the capital account and the bank account is the receiver of the balance, the capital of 50 lakh rupees. Because this 50 lakh is actually flowing in form of a capital. So therefore we say that we debit the receiver, so we debit the bank and we credit the giver, which is the capital. Now, second part is that wages and salary was paid 50,000 rupees. Now, wages or the salary account is a nominal account. As we have seen here, that impersonal accounts are of two types. One is the real account of the asset and other is the nominal account. Nominal accounts are like all the other expenses, losses, gains and revenue accounts. So similarly here, when wages are being paid, that is a nominal account and it is coming out of the bank. So bank is the giver and bank account is a personal account of the proprietor, and therefore we say that we credit the giver and we debit the expenditure here. Because the rule for the nominal account is debit all expenses. So as we are seeing that the first thing that we have to decide is which are the accounts being affected here. Secondly, whether they are real account, nominal account or personal account. And then once we have decided which account is it, what is the nature of the account, then we apply the golden rule. Similarly, when rent is being received, the rent is being received in the personal account of the proprietor, which is a bank. So we debit the receiver and rent account is a nominal account because it deals with gains and therefore it is nominal account, and there we have credit the income. And for personal account we have debit the receiver. So we debit the receiver and credit the income in this case. Now supposing somebody makes a purchases on credit. So whenever credit purchase is made, accounts which are involved here is purchase account and the creditor account. The creditor account is a personal account of the creditor and purchase account is a nominal account because purchase deals with expenditure. So we debit the expenses and credit the giver. Similarly, goods sold and payment received in check. Goods were sold, the payment is received into the bank. So bank is the receiver, it is a personal account, debit the receiver, and sale has been made. So that is a nominal account. Sales is nominal account because it's a gain account, and we credit the gains. So this is the method, traditional method by which we do the debits and credits. Now, real, nominal and personal accounts was the traditional classification of accounts. It was the ये परंपरागत वर्गीकरण था अकाउंट्स का, ये अकाउंट्स को रियल, नॉमिनल और पर्सनल में विभाजित किया गया था. अब हम देखते हैं कि मॉडर्न या ज़्यादा स्वीकार योग्य क्लासिफिकेशन कौन सा है अकाउंट्स का. So in the modern classification, in the traditional classification, only three types of accounts were recognized: real, nominal and personal. However, in the modern system, accounts could be of any of these six categories: asset account, liability account, capital account, revenue account, expenditure account, and the drawing account. And the normal balance in the asset account is a debit, because whenever asset increases, we debit the asset account. So whenever there is an increase in the asset, we debit the asset account, and whenever there is a decrease in the asset, we credit the account. Similarly, in case of a liabilities account, normal balance is a credit balance. So whenever liabilities decrease, whenever liabilities increase, it is credited, and when the liabilities decrease, it is debited. Similarly, the behavior of the capital account is similar to the behavior of the liabilities account. And then, of course, there are revenue account, expenditure account, and drawing account. So under the modern system, there are 6 types of accounts. Now let us solve the same example with the modern approach that we had taken earlier. Here what we are doing is that first we are writing the accounts which are involved in the transaction, and then we are writing what is the nature of that account, whether it is an asset account or a liability account or a capital account or revenue account, expenditure or drawing. Out of these six items, we use one of the items to categorize that particular account. And so if bank account is an asset account, we debit the increase of the money in the bank account. Similarly, capital account is in the nature of the liability account, because it is on the liability side of the balance sheet. So whenever liability account is credited, it is because there is an increase in the liability. Similarly, wages and salary is an expenditure account, and the increase is debited, and bank is an asset account, and its decrease is credited. Similarly, whenever there is bank is an asset account and increase is debited, and rent is a revenue account, and any increase in the rent will be credited. And similarly, purchase is an expense account, and debit and increase of expenditure is debited, and creditor is the liability account, and as any increase in the credit is debited. Any increase in the liability is credited, sorry. And then, of course, bank is an asset account, and any increase in the bank account will be debited, and any sale is the revenue account, and therefore any increase in the sale will be credited. So this is the modern approach towards debit and credit. Now, having decided which 2 accounts are being affected, and out of them which will be credited and which will be debited, we come to writing down the entry in the journal. So to write down the entry in the journal, the transactions are first entered in this journal to show that which accounts should be debited and which accounts should be credited. And so by way of journal entry, what we are doing is that we are identifying 2 accounts, and we are saying that this one should be debited and the other one should be credited. Journal is also called a subsidiary book. It is not the main book, but the subsidiary book. And therefore, recording of the transactions in journal is termed as journalizing the entry. It is the book of original entry, because in this book, original entries are finally made. And in this book, transactions are entered on a daily basis in chronological order. chronological order is important. Now, how do we journalize? So what is the journalizing process? All the transactions are first recorded in the journal as and when they occur. As and when they go on occurring, we record them in the journal. This record is chronological. It is in the order of the time. Otherwise, it would be difficult to maintain the record in an orderly manner. Therefore, maintaining the record in chronological fashion brings order to the maintenance of the record. Debits and credits are listed along with the appropriate explanations. Which account is to be involved, whether it is to be debited or credited. Then explanations are also mentioned as to why some account is being debited or some account is being credited. Now, two types of journals are maintained. One is a general journal and other is the specialized journal. Now, the specialized journal is used when there are many repetitive transactions of the same nature. So that we use a specialized journal, but the form of the journal is given below. It's like, first we write the date, then we write the particulars of the transaction, and then we write the ledger folio, which means that from here the transaction will go into the ledger, into that folio number. And then we indicate whether how much amount is debited or how much amount is credited. So in this way, journal entries can be made like this. Now here we have numbered the columns to make it clear the following, but otherwise they are not numbered. Normally we do not put numbers in these columns. In the first column, the date is entered, that is the year is written at the top, then the month, and in the narrow part of the column, the particular date is also entered. In the second column, the names of the accounts involved, like particulars, which accounts are involved. First, the account to be debited with the word debit is written towards the end of the column. And in the next line, after leaving some space, we write the name of the account to be credited. And before that, we write the word to. When we write the account to be credited, and before that account, we write the word to. The modern technique shows inclination towards completely omitting the debit and to also. So gradually this debit and DR and to are going because people understand by left and right. Then the next line, the explanation for the entry together with the necessary details is also given. So explanation is also to be given by as to what is the nature of the transaction and why a debit or credit is being made. Then the third column, the number of the page of the ledger on which the account is written on. In the fourth column, the amount to be debited is to be mentioned to the various accounts, and in the fifth column, if any credit amount has to be written, then that will also come there. Now, what are the points to be taken into care while recording a transaction in the journal? Journal entry can be single entry, one debit and one credit, or it could be a compound entry where there could be one debit and two or more credits, or two or more debits and one credit, or there could be two or more debits and credits. In such cases, it is important to check that the total of both the debits and credits should be equal. Now, next point to be considered is that the journal entries are recorded in several pages, then both the amount column of each page should be totaled. You have to be careful. Either we record it all on the same page, or if we record it on different pages, then we must be aware about it. So the amount column of each page should be total and the balance should be written at the end of that page. On every page, we should take the total and write down the balance. And then we start with the opening balance on the next page, which is the same as closing balance on the previous page. And therefore, by this method, the balance is being carried forward. Now, an entry in the journal may appear like this, that on May 5, like date, bank account is debited by this amount, and to Mohan means the Mohan account is being credited here, and then the explanation being the amount received from Mohan in payment of the amount which was due from him. So let us now consider some individual transactions and see how the journal entries are made out of them. So first example is Mohan commences his business with 50 lakhs in his bank account. Now this means that firm has 50 lakh rupees in the bank account. So according to the rules which were given above, the increase in an asset has to be debited to that account. And the firm also owes 50 lakh to the proprietor now. And therefore, proprietor Mohan will get an entry in his capital account. The rule given above will show that increase in capital should be credited to the capital account. And therefore, we'll write the journal entry of this transaction that bank account debit by 50 lakh and to capital account, because when we are crediting any account, we write 2 before that. Capital introduced by Shri Mohan. So number 2, let's take one more transaction here. Now out of the above, 25,000 is withdrawn from the bank. Now after having introduced 50 lakh rupees, he withdraws from the bank 25,000 rupees. By this transaction, the bank balance will be reduced by 25,000 and another asset called cash account will come into the existence. Because increase in assets has to be debited and decrease is to be credited, the journal entry of this is cash account, which is an asset account, will be debited by 25,000 and bank account, which is also an asset account, will be credited by 25,000. The explanation will say being cash withdrawn from the bank. So cash is taken out of the bank and put into the cash box. Now let's take one more example, the third example, which says that furniture is purchased for 12 lakh rupees. We apply the same reasoning. Furniture is asset account. Bank is also an asset account. From the bank, money is taken and paid for the furniture. So the bank balance is reducing and the furniture is increasing. So when the bank account, being an asset account, is reducing, we credit that and we debit the furniture account. In the next example, goods are purchased for cash 4 lakh rupees. So the required entry here is very easy to see. We debit the purchase account. Straight away we are applying the rules which we had arrived at. Bank account is again credited here. Purchase account is debited because purchase is an expense account. And when expense goes up, we debit. Next is purchase goods for 10 lakh rupees on credit from Messrs. Ram Narayan Brothers. Now purchase of merchandise is being made here and it is an expenditure item, and therefore 10 lakh rupees is debited, and Ram Narayan Brothers will be credited because that is a personal account. And in the explanation, we'll write being goods purchased, white bill number such and such. That is an explanation. So, similarly, all the other examples are given here, which we would like that the readers or the listeners of our webinar should go through all these transactions and apply the rules that we have made so far. It will be very easy for them to understand as to what is happening here. Now, when journal entry for two or more transactions are to be combined, let's say here rent account is being debited, salary account is also being debited, and credit is going into the bank account because salary and rent are being paid out of the bank account. This kind of an entry is called the composite journal entry because two or more transactions are being combined. One transaction is take from bank, give to salary. Another transaction is take from bank, give for rent. Both are combined together here in a composite journal entry. Usually the transactions in a firm are so numerous, so many times they are happening, that to record the transaction for a month will require many pages in the journal. So therefore, at the bottom of one page, the totals of the two columns are written together with the words carried forward in the particulars column. As we are seeing, there is a particulars column there. We write carried forward there at the bottom of one page. When one page is full, we take the totals of the two columns and we write the words carried forward in the particulars column, and the next page is started with the respective total in the two columns with the words brought forward there in the particulars column. So carried forward or carried down can be also written, and brought forward will be written on the first row of the next page. In the particulars column. Now we see one illustration, and here we are trying to see both the approaches, accounting equation approach and a traditional approach. You see, both approaches lead to the same journal entry. Only the approach is different. It is just like saying that various paths lead to the same God. So we are taking 5 examples here, and we are going to see by analyzing these transactions of Messrs. Sahil and Company for the month of March 2017 on the basis of the double entry system. We are going to see both the approaches, the accounting equation approach as well as the traditional approach here. So first question is, Sahil introduced capital through the bank of 4,000 rupees. Now what is happening here is Sahil is introducing the capital. So first we are taking the accounting equation approach for all these 5, and then we will take the traditional approach for all these 5. So when Sahil introduces the capital, the 4,000 rupees goes into his bank account, which is an asset, and his capital increases by 4,000 rupees, and there is no effect on the liability. As we have seen that under the account equation approach, out of the 3 categories, assets, capital and liabilities, 2 will be affected by every transaction, and the effect will be such that on each side of the accounting equation there may be either an increase or there may be a decrease. Similarly, when we say the cash is withdrawn from the bank 200 rupees, so cash is withdrawn from the bank means there is an addition of cash in the cash balance and there is reduction of cash in the bank balance in the bank, and therefore there is no change in the liability. So there is only what is happening is that one of the assets is going up and the other asset is going down. Similarly, for other three transactions, we can write down the effect, and we are writing plus and minus rather than writing separate columns. We can do that also, and that's how we are coming to the conclusion as to what are we going to do about that transaction. Because we know that whenever there is an asset and there is an increase in the asset, we debit the asset account, and whenever there is a decrease in the asset, we credit the asset account. Opposite is true for capital and liabilities. Now, when we look at the traditional approach, and we see the first example, introduction of 4,000 through the bank by the proprietor. What is happening here is that two accounts are being affected. Bank is receiving the money, and owner has given the bank balance. So two accounts are being affected, bank and capital. Both accounts are personal accounts in nature because the bank account belongs to the person as well as the capital account also belongs to the person here. And therefore, the rule that will apply here is debit the receiver and credit the giver. So giver of the capital is the owner who is giving the money into the capital account. And the receiver is the bank. So money is coming into the bank through the capital. Therefore, capital account here is a personal account and bank account is also the personal account. Because money is going into the bank account. And we say debit the receiver because debit bank, bank being the receiver, and we credit the giver, credit capital. Capital is the provider of the funds because funds are flowing in form of the capital here or through the capital account. Now let's say that in the second example, cash is withdrawn from the bank. Cash is withdrawn from the bank. Bank here is a personal account. Cash is the real asset account. And therefore the rule for this is debit what comes in as far as the real account is concerned. And as far as the personal account is concerned, we say credit the giver. So debit what comes in is for cash account, debit cash, and credit the giver is for the personal account, which is in the form of the bank account, credit bank. Now let's say loan is taken from Y of 500 rupees. Here two accounts are being affected. One is the bank because it is money is flowing into the bank, that's personal account of the proprietor. Now Y pays through the bank. So Y has given this loan and Y's account is also a personal account. So we credit the giver and debit the receiver. So we debit bank the receiver and we credit Y the loan giver. We take one more example, salary which is paid 300 rupees and still payable 100 rupees. So total salaries is 400 rupees, but 300 rupees paid and 100 rupees is still payable. So the salary is actually 400 rupees. We say salary is a nominal account here because it's an expenses account. And the rule for the salary is debit all expenses. So we debit salary by 400 and we credit the giver. Giver is a personal account, bank account, personal bank account. So we say credit the giver and therefore we credit bank 300 rupees, and the payable amount, that is salary, which is outstanding account, and so outstanding salary is a personal account, as we have seen. Therefore we credit the giver, and therefore we credit the outstanding salary account by rupees 100. So that is how the traditional approach is working. Let's see one final example also. Furniture is purchased for 500. Two accounts are being affected, furniture and bank account, because payment is being made from the bank account for buying furniture. Bank account being a personal account of the owner. Furniture is the real account, being the asset account. We debit what comes in into the furniture, and we credit the giver as far as the personal bank account is concerned. So we debit furniture and we credit bank. So on the basis of this analysis, it is very clear what is the procedure for analyzing the transactions, how do we classify the accounts, and how the rules for recording the business transactions are applied under the two approaches, like accounting equation approach and the traditional approach, and how these rules are different in both the approaches. But ultimately the accounts which are affected are the same, and the entries which are made in the books of accounts are also the same under both the approaches. So under both approaches, accounts which are affected are the same, and so also are the entries which are made in the journal. And therefore the recording of transaction is affected in affected accounts on the basis of double entry system is the same, whatever be the method of analysis which is followed by the enterprise. So in other words, we can say the accounts which are to be debited and the accounts which are to be credited to record the dual aspect will be the same under both the traditional approach as well as the accounting equation approach. So with that, we come to an illustration, and in the illustration, as you can see, the date is also mentioned here. Ajit started business with the capital 4 lakh. Virtually, they are all exactly the same as we have seen earlier. So instead of repeating them, we would like them to be done in form of an exercise by you all. You can, of course, here you look at the solution also, and you can look at the solution. And when you're looking at the solution, you should try to very sharply see which approach is being used. And if a traditional approach is being used, then the rules of the traditional approach should be applied, and the accounting approach should be used. Accounting equation approach has to be used, then the rules for that have to be applied, and the result would obviously be the same in both the cases. Now, in the next illustration, what is being asked is that certain account names are being given here, and what is being asked is to find out what is the traditional approach, what is the nature of that account in the traditional approach, and what is the nature of that account in the accounting equation approach. So as we know that in the traditional approach, the accounts are divided into two broad categories, personal and impersonal. And among the impersonal, we have the real and the nominal. So we say personal, real, and nominal like that. So under the list of the accounts, we have divided them into the real, personal, and nominal. And on the other hand, the same accounts are being labeled as whether they are asset accounts or liability account, or they are the temporary capital account. Temporary capital means the expenditure account, or temporary capital means drawings also, or temporary capital could mean gain also. So gain, expense, drawings, they are all temporary capital accounts, as we have seen earlier also. So all these accounts are therefore divided in that way. Now transactions of Ramesh are given here and we need to journalize them. The same rules will be applied once again. To journalize, you have to be very careful that date has to be written very clearly. Then in the particulars column, please remember that when a page has come to an end, we have to write in the particulars column carried down at the end of it, and on the first page of the fresh page of the journal, in the particulars column we write carried forward or carried down. Oh, sorry, carried forward. Oh yeah, brought forward, in fact. So carried down or carried forward at the bottom of the page initially, and in the beginning of the first page brought forward. And in the particulars, we are writing which account is being debited, and before the credit we write 2. Sometimes this 2 is also being forsaken. The trend is towards not writing 2 also, but normally 2 is written. As you can see, the tradition of writing by before the account debited is no longer being followed now. This 2 will also disappear in due course of time. And in the journal, there is a ledger folio also, because this entry will ultimately move into the ledger. Because when we say debit bank account, then it will go as a debit to the bank account in ledger folio on page number 1, where the bank account would be, and capital account would be on the page number 4 of the ledger folio, where a credit entry would be made in the capital account of rupees 10 lakh rupees while transferring this journal entry into the ledger. Now, what are the, having seen the various entries here, we have to look at what are the advantages of a journal. Now, transactions are recorded on the basis of the double entry system. And therefore, the advantages are that all the transactions are, first of all, they are recorded in chronological order, in the order of time. And therefore, one can get complete information about the business transaction on the basis of time. The second advantage is that entries which are recorded in the journal, they have a note of explanation for every entry, which is called narration. Narration is the word used for the explanation. For example, when we say being goods sold for cash, this is a narration of the journal entry. So narration explains what is happening there, because narration is a precise explanation of the transaction so that we can properly understand that entry. So we can understand whether the entry has been made correctly or not by reading the narration also. The third advantage is that the journal forms the basis for posting the entries into the ledger. Because entries are posted into the ledger only from the journal. If journal was not there, posting in the ledger would become almost impossible. So entry into the journal predates or presages the entry in the ledger. Rather, all the entries in the journal are taken into the ledger. Now, this makes the work of the accountant easier and reduces all the chances of making error while writing the ledger. If the ledger were to be written straight away, then it will lead to a lot of errors in the ledger if journal entries were not made initially and then transferred to the ledger. So with that, we have come to the end of this chapter, and therefore we have left out a few illustrations for you to complete. And because we have made numerous explanations to you during the course of these 3 lectures as to how journal entries are being made. We have also looked at the accounting equation approach in great detail. We have also looked at the traditional approach, where accounts are labeled or classified into 3 parts, and there are rules for applying the debit and credit principle. We have also understood the meaning of debit and credit. And so we can say that this particular chapter is covered in detail, and if you can cover this chapter in great detail and with patience, then you can be rest assured the rest part of the bookkeeping and accountancy is going to be a cakewalk for you. And at the same time, I must warn you that if you don't take this particular chapter seriously, then you would be encountering serious hurdles in your progress with bookkeeping and accountancy. So this particular chapter is the very basis. It is the very foundation of bookkeeping and accountancy, and therefore you must be very, very careful and spend as much time as possible upon this chapter and doing questions related to this chapter. We'll try to give you as many questions as possible for this chapter in our mock test that we are going to start in one or a couple of days from now. And so please bear with us and do not forget to take the mock test, because DTRTI Lucknow is, you can say, the name of DTRTI Lucknow is taken for mock tests that it gives you. And the mock test technique has been perfected at DTRTI Lucknow. And we would like you to focus on the mock test and make the mock test a vehicle for your perfection after having gone through the chapter and after having gone through the lecture. So when you're going through the lecture, whenever you are free or whenever you're traveling or you are having a cool mind, listen to the chapter, read the chapter and try to understand it. So with those words, thank you very much for having been with us, patiently attending this lecture, and those who have been patient with us, I'm very sure that they would understand the concepts very well. And we thank you for having attended this session with us, and please join us again for the next lecture tomorrow morning at 8:45.